Good afternoon, and welcome to the fourth InSTEP session of 2022. My name is Marjorie Chorlins, and I am the Senior Vice President for Europe at the U.S. Chamber, as well as Executive Director of the InSTEP series. I'm delighted to stand in for Myron Brilliant today to host this conversation. Last month, we heard from Ling Wei of the Wall Street Journal and David Ignatius of the Washington Post about a range of global challenges, including the issue that sadly remains center stage, the ongoing conflict in Ukraine. We talked about U.S. alliance strategy, China's strategic positioning, and our evolving relationships. We also asked important questions about what Russia's actions mean for global order going forward. Beyond the human toll, the war is clearly reverberating through the global economy. What does it mean to shut down ties with the world's 11th largest economy? How should we be thinking about the international price outlook, disruptions to trade, and the impact of sanctions? With many countries still working to gain economic traction coming out of the pandemic and global growth estimates being adjusted downward, what are some of the key policy responses we're seeing in advanced and emerging economies? How do we tame inflation without tipping into a recession? How do we respond to energy security challenges in Europe? And what does that mean for their green transition? And what about significant food security concerns, especially in developing economies? These and other topics are top of mind as the Bank Fund Spring meetings kick off this week. And today we're going to delve into many of these topics with two and possibly three highly respected economists. We have a lot of ground to cover, so let's get underway. Let me start with brief introductions. I'll start with Megan Greene, who's Global Chief Economist for the Kroll Institute. With a career split between the UK and the United States, Megan operates at the intersection of macroeconomics, financial markets, and politics. She was previously Global Chief Economist at John Hancock Manulife Asset and held senior roles at Maverick Intelligence, Rubini Global Economics, and the Economist Intelligence Unit. She's also a senior fellow at the Harvard Kennedy School and a regular contributor to the Financial Times. I understand she's coming to us from Cambridge, where apparently it is rainy. By contrast, we're also fortunate to be joined by Sara Johnson, who's Executive Director of Global Economics at S&P Global Market Intelligence. Some of you know Sara through her work for IHS Markit, which merged with S&P Global earlier this year. She was previously North American Research Director and Chief Regional Economist with Standard & Poor's DRI and Managing Director of Global Macroeconomics with Global Insight. Sara is past president of the Boston Economic Club and a member of the American Economic Association. She is a fellow Wellesley College alum and is coming to us from Wellesley, where apparently it is sunny. Finally, I hope we'll be joined momentarily by Christopher Smart, who is the Chief Global Strategist and head of the Barings Investment Institute. He's having a little bit of technical difficulty, so I do hope he'll be able to join us in just a moment. I'm just going to dive right in, if I can. And before we get into the questions, the topics of the day, I'd like to ask both of you about an experience that helped shape your careers. Megan, let's start with you. You received a lot of recognition for your early prediction of the Eurozone crisis of 2006. Take us back to that time. Tell us what you saw that others missed and how that experience informs how you look at sovereign debt risk today.
Yeah, thanks so much for having me. First of all, it's a real pleasure to be here. I joined the Economist Intelligence Unit back in 2007. And I covered Greece, Ireland, Italy, and Germany. That wasn't random. I actually opened up the workbooks for each of those economies and thought there are massive imbalances here in Greece and Ireland in particular. Italy never grows when times are good, and Germany's going to pay for this one day. And I was dead right, but of course I was a couple years too early. And I would say it was beginner's luck to some degree, but I think I also just wasn't politically savvy enough to know I shouldn't be saying these things. And I hope I'm always politically unsavvy and have recognized that actually my greatest value, and I think the greatest value for most economists, is when we're actually out of consensus, which is also a difficult place to sit. And so that's been a big lesson. Looking at the imbalances within the Eurozone has been incredibly useful in understanding sovereign debt crises, living that crisis, living, eating, and breathing that crisis for a number of years, set me up certainly to look at the imbalances that we're seeing right now emerging in emerging markets. I mean, emerging markets were already massively over indebted before the pandemic hit. They had to borrow more in order to finance their pandemic response. And now, as they're undergoing a fiscal retrenchment, the Fed is looking like it's going to start hiking rates pretty aggressively and increasing borrowing costs across the globe. And that's going to hit a number of emerging market economies pretty hard. And so I do think that there are a number of vulnerabilities. Also, the IMF has great programs for, real basket case countries that need a full program with full conditionality, which no country really ever wants to sign up for. Or on the other hand, countries with really pristine policy records who just need a bit of a bridge loan to get them through a tough period. And I think a whole bunch of low and middle income countries are going to fall right in between those two extremes. And there aren't great programs for them. So it's certainly something I'm looking at right now as the Fed has started its rate hiking cycle.
Megan, thanks very much for that. And you've actually touched on a couple of topics that we're going to get to a little bit later in the conversation. But first, Sara, as a fellow of the National Association of Business Economists, tell us how important regular interaction is between economists from corporations, Federal Reserve banks, and government agencies in terms of economic understanding and sound forecasting.
Thank you. I have found it certainly crucial throughout my career to interact with people in different geographies and different industries. And NABE has brought those together. I'm also fortunate to be part of now Standard & Poor's Global Market Intelligence, as well as the former IHS Market, because we have not only macroeconomists covering about 200 countries of the world, but deep expertise in various industries like energy, automotive, technology, for example. And NABE has excellent programs, as does the Chamber. We often hear from speakers from the Federal Reserve, U.S. Treasury, Congressional Budget Office, to get the perspectives of what drives policy decisions. And the connections I find most valuable, the connections those organizations bring with our customer base. I have the opportunities to see our customers in person and find out what's on their minds and what their perspectives are.
That's terrific. And of course, it makes perfect sense that that kind of engagement, especially with your customers, is going to help you assess where the risks and opportunities are in today's very volatile world. Megan, let me turn to you first, looking sort of at the global outlook, but focusing on a topic that is on everybody's mind, and that's inflation. The IMF has just increased its forecast of U.S. inflation from 3.5% in October to 7.7% today. And the Eurozone rate has ticked up from 1.7% to 5.3%. We know, as you say, that the pandemic forced governments to put money in people's pockets and offer emergency benefits to businesses. Now we're layering on a conflict and global commodity shock. And the IMF just cut the global growth estimate from 4.1% in January to 3.6% today. In a recent New York Times piece, you said, "We've never before put our economy into the deep freeze and then defrosted it." Tell us how you see the outlook for inflation and the difficult trade-offs that central banks have to make when contemplating inflation on the one hand and promoting growth on the other.
Yeah, thanks. This is the question everybody is asking me these days on inflation. And I'll start by saying that the nature of inflation in the US and Europe, or the Eurozone in particular, is totally different. So I'll start with the US. There's a big question about whether higher prices are being driven by demand or by supply. On the demand side, as you read my quote in the New York Times, we put the economy on a deep freeze and then defrosted it. And when we defrosted it, we unleashed a bunch of pent-up demand. And it wasn't just demand writ large, it was demand for stuff. So Americans overwhelmingly started buying things instead of services. That has started to reverse a little bit. And initially, all of the inflation was really in goods. because we were buying so many goods. Now we're spreading out into services a bit more. That being said, services are roughly 5 times the weight of goods in the inflation basket. So while we're reverting to our normal trends now, that inflation will continue to be elevated just because services are such a huge weight in the basket. That's the demand side. The supply side in the US is driven by 2 things, I think. One is just global supply chain issues. And that goes for issues with US ports, China's zero COVID policy causing lockdowns and factory closures, in big areas like Shenzhen and Shanghai. But it also now accounts for the Russian invasion of Ukraine, where a whole bunch of commodities generally are coming out of Russia. Those global supply chains will be mucked up for sure. So things like aluminum, palladium, nickel, a lot of key inputs into batteries and semiconductors. We will have supply issues with that. Also coming out of Ukraine and Russia is wheat and fertilizer. So we could have food insecurity issues. I expect them particularly in the Middle East and North Africa, which are reliant on Ukraine in particular for wheat. That could cause some issues too. So that's the global supply chain side that's driving prices higher. There's also a labor supply issue in the US uniquely. Our labor force participation rate dropped when COVID hit, but has never recovered. So our labor force participation rate is still well below where it was before the pandemic. And there's a big question about where the American workers all went. And if we can answer that, we can figure out if they're actually coming back. It seems like a lot of workers left the workforce because of COVID. So they were sick or afraid to get sick or taking care of people who were sick. As the pandemic becomes more endemic, that should start to abate and already is in the monthly labor market data. Also, a bunch of people retired, and it's not just that they retired, but they stopped coming back into the labor force. That likely also is hooked to health concerns, and we're starting to see that improve. And so people had a financial cushion as well. We now know that the lowest quartile of households benefited the most from stimulus measures, but have burned through them the fastest. And so as their financial cushion evaporates, they're going to have to capitulate and get a job for a paycheck. And so some of these labor supply issues should abate over the course of this year. The global supply chain issues, however, will not, and probably the demand issues won't either. And so I think inflation in the US will remain elevated through to the end of next year. Now, I'm a paid up member of Team Transitory, so I'm saying inflation will be higher, much higher than the Fed's target through the end of next year. But structurally, I think all the big drivers of low inflation over the past 15 years have mostly been turbocharged by the pandemic. Things like automation, digitalization, higher market concentration, the sorts of things have just increased over the course of the pandemic. In Europe, there actually isn't such a demand side reason for higher inflation. It's mostly really driven by the supply side. And so there it's food prices and in particular now energy prices. I would say that there's nothing that central banks can do about supply side issues. So the ECB can hike rates. It's going to do nothing about energy costs. Really, it probably won't do anything about other commodity costs. And so the ECB is in a much tougher position than the Fed, even in that I expect stagflation. So the Eurozone's growth is weaker than the US's already. It's now facing higher inflation. I think we'll be stuck in a scenario where we have really weak growth this year, really high inflation in the Eurozone, and the ECB is stuck trying to choose whether it wants to support growth and keep the recovery going or lean against inflation. It can only choose one as much as it will want to choose both. And so the ECB is in a tough spot. The Fed is also in a tough spot in that it's trying to engineer a magical soft landing without having a major uptick in unemployment. The Fed's never actually managed to do that before. But given that the US has much higher growth now and also higher inflation, I don't expect stagflation in the US. I expect growth will be more robust.
Wow, that was a fantastic overview, and actually, again, a precursor to some of the topics we'll dig into in just a minute. Sara, I do want to turn to you to talk about one of the issues that Megan raised, and that is China. Obviously, conversations about global growth usually start with China, and you have actually projected that China's economic growth is likely to fall short of the 5.5% target for 2022. Yesterday, China announced its biggest decline in consumer spending and worst unemployment rate since the earliest days of the pandemic. Talk a little bit about where China does fit into the global economy and what steps you think the Chinese government might take in order to generate growth.
Well, China is still a major driver of global economic growth. We're projecting about 5% real GDP growth this year, below target, but still very significant. And much will depend on the path of COVID-19. I think right now about 30 provinces have some type of lockdown. New cases continue to rise, but lately it's been primarily in Shanghai, in some of the Northwest industrial regions, such as Jivik. Then we're seeing the pandemic subsiding. So I think for the industrial China, the outlook is fairly good. For commerce, certainly the closure of ports near Shanghai has been a problem. Supply chains will certainly worsen before they get better. The Chinese government, I expect, will aim for economic stability and continue to loosen fiscal and monetary policies. We've seen some modest reductions in interest rates and reserve requirement ratios. We've also seen a shift towards restarting infrastructure projects, and that will help to stabilize economic growth. Another factor will be the real estate situation. China's been far too dependent on real estate to drive its economic growth, and this is one area where we are seeing some contraction and certainly a very challenging financial situation. But overall, I think we can see China moving forward. Economic growth in the first quarter of the year was 4.8% year on year. And that's with fairly robust growth in fixed asset investment. Longer term, we see a steady deceleration as a result of a decreasing working age population, as well as a significant slowdown in total factor productivity growth.
Great, thanks very much for that, Sara. I think Christopher has joined us. Christopher Smart, are you there?
I am here. I apologize. I was stuck somewhere between a VPN and a browser.
Okay, well,
I broke through, so happy to join you and happy to be with Megan and Sara.
Congratulations, and indeed, thanks for joining us, Christopher. Just very quickly, for those of you who may not know Christopher, he is Chief Global Strategist and head of the Barings Investment Institute. He's no stranger to Washington, having served as a special assistant to President Obama at the National Economic Council and the National Security Council. And he also spent 4 years as Deputy Assistant Secretary of Treasury, where, among other things, he led the U.S. response to the European financial crisis. Earlier in his career, he was actually an advisor to the Russian Finance Ministry following the fall of the Soviet Union. I have to ask you, Christopher, I mean, I want to keep on with the questions, but I've got to ask you, how did that come about? And what was your big takeaway from that experience?
Well, I apologize for interrupting the flow of the conversation. I get asked that question a lot these days. And I hasten to remind people that in the 1990s, we were rooting for the Russian government to succeed on its economic reforms and its post-Soviet configuration of its economy. It was introducing more market forces. I was working with a group of advisors with Jeff Sachs from Harvard, what was the Harvard Institute for National Development at the time. And we were really just working as a research secretariat for the folks like Yegor Gaidar and Boris Fyodorov, who were leading the reforms and needed a little bit more material to win their arguments within the Russian government. I just have to say it's as disheartening and depressing as it is for everybody else, and heartbreaking looking at what's going on in Ukraine, but also to think of what we tried to do to integrate the Russian economy into the global financial architecture, the G20, the IMF, the G7, then the G8, and now to be systematically shutting them out of all of those institutions. And I'll just finish by saying, the problem I think we're going to face is this is Russia's not going away. Russia's not going to back down, and we're going to be facing with an increasingly isolated and probably dangerous Russia for many years to come, unfortunately.
Yeah, I confess I share your view that, in the early days after the fall of the Soviet Union, a lot of us in the private sector were very optimistic about prospects for building relationships there and creating new markets and bringing products and services to consumers and so on. And It certainly has been a great sadness and disappointment to not only see that has not come to pass, but that indeed we are on the sorry trajectory that we are on now. Christopher, I want to go ahead and jump in and ask you a question. We've talked already about inflation and a little bit about China. I want to talk to you about oil and gas supply. About a month ago, you outlined 3 market dynamics that Barings would be watching to better understand the implications of the invasion of Ukraine. They were: are there financial stress? Are there signs of financial stress in markets that may seem insulated from either Russia or commodity prices? Second, would higher oil and gas prices be lasting or bring new suppliers into the market? And third, how would the world's central banks determine how much inflation needs taming amid weakening growth trends? Megan's talked about the central bank's response to inflation, so I'd really like to probe the first 2 points. First, are you seeing any signs of economic stress in surprising areas? And second, can you talk about some of the issues surrounding the ability of new oil and gas producers to step in to help meet global energy needs?
On the first point, we saw in the early days a lot of market turmoil, particularly around commodities prices, and we saw that short selling in the nickel market and the London Metals Exchange, and the apparently Chinese investor who was caught short. Those are the kinds of things, and frankly, I expected to see more of, because Russia is such a large part of the global economy and financially integrated. And frankly, I think a lot of investors were caught by surprise by what happened in Russia. We haven't really seen, I don't think, a lot of those shocks yet, but Russia hasn't yet defaulted on anything officially. And so I'm still kind of bracing for, we all know what our direct exposures are to Russia, but we're not really sure who we're exposed to, who may, own that insurance contract on the Russian oil tanker that can't deliver its oil, or, can't recover the 500 airplanes that have now been essentially expropriated within Russia and were part of a series of leasing arrangements. So I am expecting a little bit more fallout from that in the months ahead. To your point about oil, our team is focused a lot on, they spend a lot of time thinking about, in particular, the U.S. shale sector and whether they would come back in. It would be very profitable, frankly, for them to operate at these higher prices of oil that we've seen right now. But we also see a lot more capital discipline on the part of those operators and, frankly, their investors saying, wait a minute, we don't want to be drawn. We've seen this game before. We know the price can go up. We know it can come back down again. And we're not quite ready to step in until we feel like these are durable prices right now. So that's why we're still expecting prices to remain higher for longer. And frankly, on the other side, we're expecting the supply from Russia to be slowly, it will find other ways onto the global market, but Europe is going to wean itself, I think, from Russian oil over time and Russian gas over time. And that will lead us to, I think, higher energy prices rather than lower prices.
Well, Christopher, that's a perfect segue into the next question I wanted to pose to Megan. It's clear, as Christopher said, Europe is learning the hard way that it has to diversify its energy supplies and is studying plans to cut Russian gas imports by 2/3 over the course of the next year, in addition to the ban they just announced on imports of coal, although that won't take effect immediately. Now, as we see the situation continuing to worsen in Ukraine, obviously the political pressure is going to be intensifying to block imports of Russian oil. That's especially painful for a country like Germany. In the meantime, the Europeans have set a very ambitious plan to address the climate crisis. You have written about how the EU could pay for significant spending needed to accelerate its green transition, and how that investment could boost growth in the medium to long term. Can you lay out that scenario for us where Europe emerges potentially from this crisis with greater resiliency? Is that even possible?
Yeah, so I can lay out the answer. The short version is it's never going to happen, but I can explain how we could get there, hopefully. I mean, what the green transition does to growth is a topic of great dispute among economists. It's not just that we can't agree the magnitude of the impact on growth, we can't agree the direction either. And it's because it all depends on the choreography. So if you find alternatives to fossil fuels and just substitute the heck out of them, then that can be quite a big stimulus for an economy, and that can be good for growth. There are always winners and losers. The losers will end up being probably savers, given that interest rates will have to be, at zero or negative, and also the fossil fuel producers. That might be, a cost worth incurring, particularly now, given the urgency of the green transition. The other way to approach a green transition is not with carrots, but with sticks. And so by putting a price on carbon effectively, and that will push up not just the price of energy, but the price of anything that requires energy to make it, which is roughly all goods. And that's more the approach that the Europeans have gone with. They've gone with a bit of a stick and carrot approach. The Americans have just gone with a carrot approach. We're just so far trying to subsidize things. But the way to actually succeed in this green transition in Europe and not make it a huge drag on growth when growth is already incredibly tepid is to go ahead and find alternatives to the energy sources we have and subsidize them like mad. The central bank can do that by using dual interest rates, so cutting interest rate to negative territory for banks that go ahead, borrow from the ECB at that deep negative rate and pass the money on for green investments specifically. So that's one option. Unfortunately, I'm saying it's never going to happen, largely because the central bank is in tightening mode, not easing mode. And so I just don't think that the ECB is willing to pick up the mantle. There's a possibility we could get some subsidy from the fiscal authorities, but that's going to be difficult. I think the ECB and the Commission are in a game of chicken right now, whereby the ECB is saying, look, there's going to need to be a lot of spending in Europe on things like defense and the green transition and energy subsidies. And we're going to pull back on our stimulus at the moment. So it's over to you, fiscal authorities. And the fiscal authorities right now are saying, well, we don't really need a new big fund like we set up after the pandemic hit because we have some money left over from that fund. And so right now it doesn't look like we're going to get anything out of the fiscal authorities, and the ECB is going to scale back its accommodation. It's possible that maybe the fiscal authorities will come to an agreement about a new recovery fund, but they're pretty far away from that now. So there is economically, there's the scenario where you could have the green transition happen pretty quickly and actually be good for growth. It's just not my base case scenario.
Got it. So just a quick follow-up question. I mean, we know that the Europeans have set aside funds, recovery funds, that they are providing to member states, a substantial portion of which has to be dedicated to the green transition, and another portion of which has to be dedicated to the digital transition. Are you suggesting that that kind of support will make it tougher for Europe to achieve these transitions or to sustain the cost of achieving those transitions?
Well, I think that what we need is more money than what's on the table as part of the Next Gen EU funds that you're describing. And so the Next Gen EU funds could be a model for creating another recovery package off the back of this war in Ukraine. But the jury's still out on whether the Next Gen EU funds are a success or not. It turns out EU countries are actually not very good at absorbing funds from Brussels. If you look at the history of the absorption of cohesion and structural funds, on average, EU countries absorb 40% of it. Italy and Spain absorb even less of it. Ironically, Greece is really good now at absorbing EU funds. It's learned that lesson the really hard way. So even though there's a lot of money on the table, it's a question of having good projects and good leadership at the local level to implement them. And the jury's still out on that. So that's a concern. But we might not even find out if what we need really urgently is more funding for the green transition, defense spending, energy subsidies. It's possible that fiscal authorities could use that Next Gen EU fund as a model for another recovery emergency fund to address these big issues. It just doesn't look like that's possible. For example, the German coalition explicitly has it in their coalition agreement to not have any more recovery funds. The German finance minister has come out on the record very clearly to say he doesn't think any more money is necessary. I think that's probably wrong. If you look at the estimates for how Europe can wean itself off of Russian energy, they take every assumption to the extreme. They're incredibly aggressive, and I think it's probably very difficult to reduce the EU's energy reliance on Russian energy as much as they're hoping to by the end of this year.
I have so many more questions I could ask you since I focus on Europe, but I do want to move ahead and broaden out the aperture again. Sara, coming back to you, we talked a little bit about China earlier, and I want to put that in the frame of globalization, or more accurately, deglobalization. Obviously, the trade war between the U.S. and China has been prompting business leaders to diversify their sources of supply where that's possible, and has created political pressure to bring manufacturing back home. If anything, the pandemic has only underscored the importance of supply chain resilience. And now the current conflict in Ukraine is prompting a renewed look at dependencies on markets like Russia that are willing to engage in economic coercion. Together, these developments have prompted some economists and others, from Paul Krugman to David Brooks, to put forward various deglobalization scenarios. The Economist reports that between 2008 and 2019, world trade relative to global GDP fell about 5%, and global long-term investment fell by half between 2016 and 2019. What are you hearing from your clients on supply chain strategies? And do you subscribe to the deglobalization narrative?
Frankly, I don't. I think the end of globalization has been greatly exaggerated. But yes, there are challenges. I think you hit the key word, diversification. We've seen weather events over the ages. We've seen pandemics now. We've seen wars. And all of these have taught us that you need a diverse global supply chain. And I think the recent evidence is also rather optimistic. We're seeing very solid growth in world trade. This year, we're projecting global export volume will increase almost 5%, while global real GDP growth we estimate at 3.2%.
Mm-hmm.
And moving forward, we also see trade outpacing overall economic growth. And why is this? I think it's the number of free trade agreements or trade partnerships that have evolved over the years. If you look around the globe and where will we see the most vibrant growth, typically it's in Asia. And that's the region that has the comprehensive and progressive Trans-Pacific Partnership. This year, we have the start of the Regional Comprehensive Economic Partnership that includes China, Japan, South Korea, and the major ASEAN countries. In Africa, we have the Continental Free Trade Area.
Mm-hmm.
So free trade is happening, freer trade. And this has major economic advantages. In a market-driven economy, you will see global trade to take advantage of differences in resource endowments and differences in physical human capital.
Mm-hmm.
So I expect free trade will continue. What are we hearing from our customers? Well, one thing that I would like to note is that our S&P Global monthly surveys of purchasing managers continue to show that vendor delivery times are lengthening. not as extensively as a year ago, but it's still certainly a problem, and it's leading to survey record increases in input costs for businesses. Also, if you look at the shipping situation, logistics will remain a problem. While we've seen some easing of congestion at the ports, we're seeing more problems inland in trucking and rail.
Mm-hmm.
Also, if you look at the calendar, this summer we have labor negotiations at the West Coast ports, which could certainly create some problems. And we also will have the purchasing ahead of the holiday seasons. That will probably move forward. So the shipping problem could get worse this summer and fall before it gets better.
If I could just add on, I think the other important thing about globalization to what Sara just mentioned is that I would expect we could see a big uptick in an increase in globalization of services.
Mm-hmm.
Those of us who've lived to operate our businesses online from a distance remotely mean that we can also deliver services in many cases across borders that we hadn't taken advantage of before. So again, as Sara pointed out, I don't think globalization is at all dead. And in fact, there are probably we're pausing for the next leg forward, I would argue.
That's a really great point. Obviously, services accounts for a substantial portion of our trade, and no doubt that trend will continue. I guess I just wonder, Sara, though, are your clients feeling political pressure when it comes to manufacturing to move their stuff back home?
Well, perhaps they're seeing some opportunity for subsidies to encourage that. And certainly if you look at the semiconductor industry, there are a number of major investment projects on the horizon. But I don't think it's realistic to expect a return to the manufacturing base that we had 20 or 30 years ago.
Got it. Okay, thanks for that. Christopher, I want to come back to you and turn the lens a bit to a different part of the world, beyond the U.S. and Europe and even China, to talk about developing economies, which obviously have had their own share of vulnerabilities well before the current conflict in Ukraine, including significant debt service burdens, which Megan alluded to earlier in the conversation. Indeed, World Bank President David Malpass has suggested that 60% of low-income countries are already in debt distress or high risk of it. Some developing countries are oil exporters and they may see a windfall, but many import energy and food, and those high prices that we've been talking about are extraordinarily painful. The UN has warned that people's resilience, particularly in import-dependent regions like North Africa, is at a breaking point, especially because of the high cost of food. Obviously, going back decades, food shortages and price inflation have been at the root of people taking to the streets and calling for change. How do you think about today's circumstances from a humanitarian and global political risk perspective?
Well, I think there are at least two or three things going on. I think, first of all, a lot of these countries were still recovering from the blow of the pandemic, and there had been some very important developments through the World Bank and particularly the IMF to provide some sort of debt relief to those countries that were facing the biggest challenges from the pandemic. Obviously, the shock from Russia is a shock to, as you say, energy and food prices. It benefits those who are the energy exporters, really hurts those who are the food importers. And it's going to take, I think, a differentiated approach for those countries across the board. I don't think we can kind of pretend that one size solution fits all of them economically. I will say, I think there's another element we need to start taking into account, which goes back to Ukraine and Russia. the BRICS, remember we used to talk about them a lot. Those are countries, besides Russia, China, India, Brazil, and South Africa, are still very much on the fence on Russia and sanctions and engagement with Russia. And Secretary Yellen put down a marker this week saying, we need everybody to be on side. And I think that's going to complicate all of these efforts to help these countries who are really trying to get through one part of the cycle into the next part of the cycle. It's never good for these countries going into a Fed hiking cycle, in addition to the other problems that they face. And now on top of that, we're going to put a test, I think, against many of them saying, are you with us or against us on Russia? And I think that's going to be yet another complication to work through. So a lot of moving parts to a question, any question that begins with developing markets involves a lot of moving parts.
Absolutely. Thank you for that. Well, we've got a little bit of time left, but I'd like to do a couple of round robin sort of rapid response questions. And I'm going to go back to you, Megan. We've talked about a number of issues today, obviously, and many of them tie together very, very obviously. But you predicted before anybody else did the Eurozone crisis. So what is it that you're seeing today that we haven't been talking about that maybe gives you pause?
I guess one thing I might worry about is the U.S. corporate sector. It's not an immediate worry, though. I'll start with that. But I would say that before the pandemic hit, we economists were trying to figure out what was going to spark the next downturn. And most of us landed on the corporate leverage. Companies had leveraged up massively, leveraged loans had expanded unbelievably with really weak covenants. And so the worry was, if you had a rate hiking cycle, that could cause a whole bunch of companies to be downgraded. All these fallen angels would cause massive selling, and that could be financially destabilizing. Nobody talks about that anymore. I think it's largely because corporates have built up a very large cash base, and so that will provide a buffer for a while. But if you assume that corporate profits have probably already baked in all the good news, and so the risk is all on the downside there, and rates are really just going up, you could see some companies start to get into distress. And then, as Christopher was saying, with the fallout from the Russian invasion, we don't know who's got exposure to what exactly. You could end up seeing some cascading defaults. I think the Fed would step in, but it is a risk that no one's really talking about.
Got it. Sara, how would you respond to the question?
Well, I'm certainly concerned about inflation. We've had a period of really unprecedented fiscal and monetary stimulus. During the pandemic, inflation expectations could become unanchored. We see inflation expectations drifting upward. I think it will be a very difficult task to bring inflation under control. And financial markets could have some disappointments along the way. I think equities may be overvalued or factor in overly optimistic corporate earnings projections. So we could have a number of setbacks in financial markets, reverberating then in the macroeconomy.
Interesting. Christopher, how about you?
Well, I agree with both what Megan and Sara highlighted. I guess I would add, maybe going back to an earlier answer, I worry about Russia. It's not going away. The problem isn't going to get solved. I think we should expect to be living with these kinds of sanctions for decades. And I pause as I use the word, but we're always very good at putting sanctions on. Very hard for us as democracies to take sanctions off because we tend to move the goalposts. But that aside, we're now dealing with a very large economy, very important supplier, a lot of very important commodities, inputs to the global economy. And then I'll just go back to what I was saying earlier. We're taking role in the sense that Europe and the United States are sort of going out to these other, to use a word from another era, other non-aligned economies in the G20, and we'll see what happens this weekend as they gather, who are desperate to stay on the fence as best they can, but we're going to make it increasingly difficult for them to stay on the fence. And I worry that all of these things around the climate agenda, debt restructuring, other support for developing countries are going to get stalled and caught up in, again, a litmus test. Very important what we did to sanction Russia, but I worry that that's going to be infused in almost anything we do as we look at the world, with some very difficult to predict consequences.
Okay, well, thanks very much for that. I won't say that that's a depressing round of answers, but it is a sobering round of answers. And as we come up to the end of the hour here, I would like to try to end on a positive note. And I'm hoping that each of you, I'll start back with you, Christopher, can identify, is there a bright spot on the economic horizon in the near term that you see?
Well, it's spring. I think what we do tend to forget is we look for, I think as economists, we sort of look for the problems. This is a very strong economy. It's getting a lot thrown at it, the U.S. economy, I mean, in particular. A lot of pressures, more expensive money, more expensive commodities, more expensive energy, and political uncertainty. But if any economy can withstand it, it's the one we have today with consumer balance sheets, corporate balance sheets. Generally, the Fed is tightening, but it's accommodative right now. So I guess we should not forget the starting point is quite strong.
Sara, how about you? Where's the bright spot?
I think it's related to the pandemic that we've kind of learned to live with COVID-19. We're keeping our economies open. Services, travel, tourism is coming back. And that will help to kind of rebalance a lot of the disruptions that have plagued the economy.
Megan, how about you?
Yeah, so I think the bright spot for the U.S. and European economies is probably productivity growth. We haven't had much for roughly 2 decades. But what we do know is, according to surveys during the pandemic, a lot of companies took the opportunity to automate and digitalize a lot. Mm-hmm. And as you mentioned earlier, Marjorie, the next Gen EU funds have to be partially earmarked for digitalization. So that should help as well. We know that even though rates are going up, they're from incredibly low levels, particularly in real terms where they're negative. So I think the environment for borrowing and investing in this sort of technological innovation will remain for a while, even as the Fed in particular hikes rates pretty aggressively this year. And so I think that, we'll see that productivity growth has increased, which fundamentally boosts potential growth, and that's a positive.
Fantastic. Well, look, we're at the end of the hour, and I do want to thank our guests, Megan Greene, Sara Johnson, and Christopher Smart. As a non-economist, you all have done a tremendous job of helping me understand in very clear terms where the opportunities are and where the real risks lie. Obviously, these are topics that we will return to in subsequent InSTEP programming, and we'll look forward to being in touch with all of you very soon with news of our next program. Thank you, everybody, for joining us, and have a great evening.